The most dangerous moment in financial history is not when a currency collapses, but when everyone believes it cannot, and that belief is exactly how power quietly slips away. The US dollar did not wake up one day weaker. It began losing influence the moment confidence turned into complacency, and dominance was mistaken for permanence. For decades, the dollar sat at the center of global trade, oil pricing, debt markets, and reserves, not because it was perfect, but because the world trusted it more than the alternatives. But history shows that trust is not permanent capital. It must be constantly earned. Every dominant currency before the dollar followed the same psychological pattern. First, it solved real problems, then it became a habit, and finally, it became a risk people ignored. The British pound once ruled global trade, yet its decline was so slow that generations failed to notice until power had already shifted. The Roman denarius didn't collapse through chaos. It was diluted quietly until people stopped believing in it. Even the gold standard didn't end because it failed suddenly. It ended because governments needed flexibility more than discipline. Today, the dollar still looks strong on the surface, but strength and dominance are not the same thing. Behind headlines and charts, countries are adjusting trade agreements, central banks are diversifying reserves, and financial systems are being redesigned to function with less dependence on one currency. This is not rebellion, it is preparation. And preparation always begins before public panic. The real risk is not a crash, it is delay of the assumption that what worked for decades must continue unchanged. History never rewards that assumption. It rewards those who recognize shifts while they still feel invisible. And if currencies don't lose power suddenly but gradually, then how many early signals are already being ignored today? How many people are still waiting for a headline that will arrive too late? And are we already living inside the first chapter of a monetary shift? Most people haven't all noticed yet. If the dollar didn't lose power suddenly but slowly, then when did the shift actually begin? Who noticed it first? And why do dominant currencies always plant the seeds of their own decline? The US dollar did not become powerful by accident, and understanding how it rose explains why its dominance now carries hidden weaknesses. After World War II, the global economy was shattered, Europe was broken, and trust in most currencies had collapsed. While the United States emerged with industrial strength, gold reserves, and political leverage, the Bretton Woods system placed the dollar at the center of global finance, tying other currencies to it and linking the dollar itself to gold, creating a structure where stability depended on American discipline. For decades, the system worked not because it was flawless, but because it solved a global problem. The world needed a trusted anchor. Even after the gold standard ended in 1971, the dollar's role didn't disappear. It evolved. Oil was priced in dollars, trade settled in dollars, debt issued in dollars, and reserves stored in dollars, turning the currency into an infrastructure rather than just money. This is where dominance quietly transformed into dependency. When a system becomes too central, the entire world begins adapting around it, and the issuing country gains extraordinary privilege. The ability to borrow cheaply, run deficits longer, and export inflation without immediate consequences. But history shows that privilege always carries a cost. The more the world depends on one currency, the more pressure builds on that system to serve conflicting interests. Domestic needs begin to clash with global responsibilities, discipline weakens, and shortcuts become tempting. Over time, this very flexibility that made the dollar powerful also made it vulnerable. Debt expanded faster than production. Policy decisions prioritized short-term stability over long-term trust, and confidence became assumed rather than protected. The danger was never visible because dominance hides fragility better than weakness does. And when trust becomes a habit instead of a choice, systems stop correcting themselves. This is not failure, it is the natural outcome of unchecked success. Every dominant currency reaches this stage, where its strength blinds people to the costs of maintaining it. And if the dollar's rise planted the seeds of global reliance, did it also plant the seeds of quiet decline? And at what point does dominance stop being protection and start becoming a liability? If the dollar's dominance was built on trust and convenience, what happens when the world begins seeking alternatives quietly, and which historical warning signs appear just before confidence starts to shift? The decline of the British pound did not begin with collapse or crisis. It began with overconfidence. And that is why its story matters so much for understanding the dollar today. For more than a century, the pound was the world's dominant currency, backed by the largest empire, global trade routes, and financial institutions that shaped modern banking. London was the center of global finance in the same way New York later became, and for a long time, no serious alternative existed. But dominance made Britain comfortable. Wars were financed through debt, colonies masked structural weakness, and the cost of maintaining global power slowly exceeded the economic return. After World War I, the pound technically remained powerful, but its foundation had weakened. Britain tried to restore its pre-war status by returning to the gold standard at an unrealistic valuation. prioritizing prestige over economic reality. This decision protected appearances but damaged competitiveness, drained reserves, and forced painful domestic adjustments. The world didn't abandon the pound overnight, it adapted gradually. Trade diversified, reserves shifted slowly, and confidence eroded silently. Even after World War II, the pound still existed as a reserve currency, yet its role had already shrunk. By the time the decline became obvious, the shift was irreversible. This pattern repeats throughout history. Empires and currencies do not fall when they are weak. They fall when they attempt to preserve dominance instead of adapting to new realities. The lesson is not that power disappears suddenly, but that clinging to old systems accelerates decline. The pound story shows that maintaining a global currency requires sacrifices that eventually collide with domestic stability. When domestic pressure rises, global responsibility becomes harder to sustain. And when a currency issuer chooses internal relief over external trust, confidence doesn't vanish immediately, it quietly relocates. The most dangerous moment is when leaders and citizens believe status alone guarantees survival. That belief delayed reform in Britain and magnified the cost of adjustment later. If history doesn't repeat but rhymes, then the uncomfortable question is whether the dollar is facing the same choice Britain faced decades ago, and whether the world is already preparing for a transition most people still refuse to acknowledge. If the pound didn't lose dominance through collapse, but through stubborn preservation, then is the dollar repeating the same mistake? And how can we tell when history starts to rhyme instead of repeat? Every major currency decline in history leaves behind early warning signals, and the most ignored of those signals is excessive debt masked by confidence. Debt itself is not new. Empires and nations have always borrowed, but the relationship between debt, productivity, and trust determines whether a currency strengthens or slowly weakens. In the case of the dollar, borrowing became easier precisely because the world demanded dollars. Foreign governments, institutions, and investors recycled trade surpluses back into U.S. debt, creating a feedback loop where deficits felt painless and discipline felt optional. Over time, this distorted incentives. Spending expanded faster than long-term productivity, political cycles encouraged short-term relief over structural reform, and monetary flexibility replaced restraint as the primary tool for stability. History shows that this phase always feels safe because consequences are delayed. Rome diluted silver content to fund obligations, Britain borrowed to preserve global stature, and the United States expanded debt to sustain growth and global influence simultaneously. None of these actions caused immediate collapse, but they shifted risk forward. The danger is not the size of the debt alone. It is the assumption that demand will always exist regardless of policy choices. Once trust becomes assumed, systems lose their self-correcting mechanism. Inflation, financialization, and asset dependence quietly replace productive expansion. The economy begins rewarding leverage more than innovation, speculation more than resilience. These are not signs of imminent failure, they are signs of structural imbalance. An imbalance is what slowly drains a currency's influence. When central banks are forced to choose between price stability and debt sustainability, credibility weakens even if markets remain calm. The world doesn't react emotionally, it reacts mathematically. Alternatives are explored, hedges are built, and exposure is reduced without announcement. By the time headlines appear, the adjustment is already well underway. History teaches that currencies rarely collapse under pressure, they erode under comfort. And if debt, deficits, and monetary expansion are early signals rather than sudden threats, then how much imbalance can a system absorb before confidence starts shifting elsewhere? And how many warnings does history need before they are taken seriously? If debt and flexibility slowly weaken trust, then what happens when the world finally begins preparing for life beyond one dominant currency? And where do those preparations first appear? De-dollarization does not begin with announcements or confrontations. It begins with insurance, and that is why most people misunderstand it. When countries reduce reliance on the dollar, it is rarely an act of defiance. It is a response to risk concentration. History shows that systems dependent on a single anchor eventually seek balance, not because the anchor fails, but because dependence itself becomes a vulnerability. In recent years, bilateral trade agreements settled in local currencies, expanded gold reserves, alternative payment systems, and regional financial frameworks have quietly increased. These moves are not designed to destroy the dollar. They are designed to ensure survival if access becomes costly, unstable, or politically constrained. The dollar's strength created incentives for alternatives by centralizing too much power in one system. Sanctions, financial restrictions, and policy spillovers made currency exposure a strategic consideration rather than a neutral choice. Once money becomes a tool of policy, trust begins shifting toward optionality. The world does not abandon dominant systems abruptly. It builds parallel pathways slowly. This mirrors earlier transitions in history, where trade routes diversified before empires declined and reserve assets shifted before currency dominance faded. Importantly, de-dollarization is uneven and fragmented, which is why it feels invisible. Some regions move faster, others remain deeply integrated. But the direction matters more than the pace. Markets do not need consensus to adjust, they only need alternatives to exist. And alternatives don't need to replace the dollar completely to weaken its influence. Even partial substitution changes bargaining power, pricing dynamics, and financial leverage over time. The dollar can remain dominant and still lose relative power, just as the pound did while still circulating globally. The mistake is thinking in binary terms, collapse or survival. History operates in gradients, not absolutes. Influence shrinks long before relevance disappears. If de-dollarization is best understood as insurance rather than rebellion, then the real question is not whether it will succeed, but how quietly it is already reshaping global behavior, and whether people will recognize the shift before its effects become permanent. If the dollar isn't being replaced but slowly hedged against, then what role will new technologies, digital currencies, and alternative systems play in accelerating or slowing this shift? The weakening of the dollar does not only affect global markets, it reshapes the strategies of entire countries and economies, and understanding this impact is crucial for interpreting what is happening today. Nations that hold large portions of their foreign reserves in dollars face subtle but real pressure when its value declines. Even a modest drop reduces the purchasing power of reserves, complicates debt repayment, and shifts the balance of trade. Countries with dollar-denominated debt may initially benefit from cheaper repayments in local currency terms, but over time, the unpredictability of a weaker currency introduces risk and forces governments to rethink fiscal strategy. Beyond balance sheets, trade dynamics shift quietly. Imports become more expensive, exports may gain temporary competitiveness, and currency volatility forces adjustments in pricing and investment strategies. History shows that when a dominant currency begins to weaken, countries hedge first, not abruptly. They diversify reserves, establish alternative trade agreements, and develop regional financial infrastructures to reduce dependency. These measures are slow, often invisible, and rarely make headlines, but they set the stage for long-term realignment. The dollar's dominance has created a network of reliance that amplifies both its strength and vulnerability. When partners start planning around partial alternatives, influence begins eroding gradually. Economists, central bankers, and policymakers track these patterns closely because the signals are predictive. Shifts in reserve allocation, trade currency changes, and adoption of alternative payment networks all indicate how global trust is redistributing. For ordinary people, these shifts may seem abstract, but they are connected directly to stability, pricing, and even inflation in local economies. If countries are quietly preparing for less dependence on the dollar, then the real question is whether individuals and investors are doing the same, and how early adaptation can make the difference between financial resilience and unexpected vulnerability. If entire economies adjust quietly to a weaker dollar, then how are everyday citizens and investors affected, and what strategies could protect them from gradual loss of purchasing power? While nations adjust to a weaker dollar, the impact on everyday people can be far more tangible than the abstract shifts in reserves and trade agreements, because a declining currency quietly erodes purchasing power, savings, and long-term financial security. When the dollar loses strength, imported goods, fuel, electronics, and everyday essentials slowly become more expensive, often before inflation statistics fully reflect the change. Wages may rise in nominal terms, but the real value of money, what it actually buys, can stagnate or fall. This is why many citizens feel financially strained despite apparent economic stability. Traditional savings accounts and low-yield investments become less effective as the real value of stored money diminishes over time. History provides lessons here. In times of gradual currency decline, people who diversified through gold, real estate, or international assets retained relative stability, while those who relied entirely on domestic cash saw purchasing power quietly erode. Modern investors have more tools, including access to global markets, alternative currencies, and digital assets. But the principle remains: diversification is protection against gradual systemic shifts, not just sudden shocks. Online communities, financial blogs, and discussion forums have increasingly highlighted awareness about inflation hedges, currency risk, and global investment strategies, signaling that ordinary individuals are slowly catching up to patterns economists have studied for decades. The danger lies not in panic, but in complacency, assuming that what worked for decades will continue indefinitely. The real lesson is that the weakening of the dollar is a slow-motion event, one that rewards attentiveness and foresight and penalizes ignorance. If nations and investors alike are making subtle adjustments, then what steps can individuals take today to protect their purchasing power? And how much of the world is already shifting resources quietly before most people notice the impact? If individuals can safeguard wealth by anticipating slow shifts, then what signals should we monitor daily? And how early must adaptation begin before gradual losses become unavoidable? History demonstrates that the decline of dominant currencies rarely happens suddenly. It unfolds in patterns that repeat across centuries, and recognizing these patterns is essential for understanding the dollar's trajectory. Every major currency that once ruled global trade, the British pound, the Dutch guilder, the Roman denarius, experienced long periods of gradual erosion, where small shifts in trade, debt, confidence, and international trust accumulated into a structural weakening before any dramatic collapse. The mechanism is always similar. First, dominance breeds complacency. Then, systemic reliance on that currency increases worldwide. Finally, subtle pressure points, rising debt, inflation, alternative reserves, political challenges gradually weaken the perception of stability. In modern terms, the dollar's position is being tested by multiple factors simultaneously: high national debt levels, unprecedented monetary expansion, and geopolitical shifts that incentivize diversification away from dollars in global trade and reserves. Even as the currency remains dominant in headline statistics, the underlying trends mirror historical declines of other major powers. Observing these patterns provides both warning and guidance. History favors those who recognize incremental change and adjust accordingly, not those who wait for headlines to confirm what has been obvious to those watching early signals. For individuals and investors, this means understanding the trajectory is more important than obsessing over daily market swings. It is not sudden catastrophe that threatens financial stability, but slow erosion that gradually reshapes purchasing power, debt sustainability, and wealth accumulation. The pattern is clear. When trust and confidence erode subtly, the world prepares quietly, adjustments happen incrementally, and only later do markets and ordinary citizens perceive the magnitude. If the dollar's trajectory is following these historical rhymes, then what lessons can we draw from past currencies about timing, preparation, and strategic adaptation? And how will these lessons determine who thrives in the next phase of global finance? If history always rhymes and patterns repeat, then which signals are most critical to watch today? And who will benefit most from recognizing the shift early? The future of the dollar is being shaped not just by debt and domestic policy, but by global alternatives that quietly redistribute financial influence, and understanding these shifts is critical for anyone concerned with long-term stability. Nations are increasingly exploring ways to reduce dependence on the dollar without creating immediate disruption. Trade agreements settled in local currencies, increased gold and commodity reserves, regional payment systems, and even early adoption of central bank digital currencies are all signals that global actors are hedging their exposure. History shows that such diversification rarely leads to sudden collapse. It creates slow, incremental shifts in relative power. For the dollar, this means that dominance may remain in name and function, while influence subtly declines over decades. Investors and citizens alike feel the effects through inflationary pressures, shifting asset values, and adjustments in global trade pricing, often before they notice structural changes in headlines. Digital currencies and blockchain-based systems amplify this effect, enabling settlements and reserves to exist outside traditional banking structures, further diluting concentration risk. Precious metals like gold retain the same role they have for centuries: insurance against currency erosion. These are not dramatic revolutions, but slow-moving currents that realign the global financial system. Understanding this context is essential because it allows anticipation rather than reaction. The lesson from history is consistent. When the world prepares quietly for alternatives, the dominant currency loses relative leverage gradually, and those who pay attention benefit while those who ignore the early signs are forced to adjust later under pressure. For ordinary people, this means watching reserves, trade shifts, adoption of digital systems, and geopolitical financial strategies closely. The important question is not whether the dollar will disappear, but how it will share power over time, and who will have positioned themselves to navigate this slow transformation effectively. If the dollar is gradually losing influence while alternatives rise quietly, then how can ordinary people, investors, and policymakers spot the early signs? And what strategies allow them to stay ahead before the shift accelerates? The story of the dollar's slow loss of power is not one of sudden catastrophe, but of gradual transformation. And the lessons it offers are both historical and practical. History repeatedly shows that dominant currencies fade incrementally through a combination of overconfidence, debt accumulation, and the quiet search for alternatives by other nations. The British pound, the Roman denarius, and countless others did not vanish overnight. They eroded through subtle shifts that went unnoticed by the public until it was too late. Today, the dollar remains dominant in headlines and markets, but underlying trends, rising debt, monetary expansion, de-dollarization efforts, digital currencies, and gold accumulation, indicate that influence is shifting. For individuals, investors, and policymakers, the key takeaway is awareness. Gradual changes reward those who observe early and adapt accordingly, and penalize those who assume stability will last indefinitely. Protecting wealth, purchasing power, and long-term security requires paying attention to signals such as reserve diversification, trade settlements outside the dollar, and inflation trends that might otherwise be dismissed. The broader lesson is that dominance is never permanent, and power slowly fades when complacency replaces vigilance. Even as the dollar continues to function as the world's main currency, subtle shifts are changing the rules of global finance in ways most people fail to notice. The question is no longer, will the dollar collapse, but rather, how will individuals, nations, and institutions adjust to a system where the dollar is still powerful but no longer unquestioned? History does not reward certainty. It rewards preparation. By studying patterns of past currency decline, analyzing current macro trends, and observing the quiet rise of alternatives, viewers can understand not just the dollar's journey, but also the fundamental lessons of economic power, trust, and adaptation. The world is already changing, and the only choice left is whether you notice early enough to act or wait until the signs are undeniable. If history teaches that dominance fades gradually rather than suddenly, then what steps should you take today to protect your wealth, understand global trends, and prepare for the future before it becomes inevitable?